I think your sound might be turned off.
How about now?
That's better. Thank
Can you hear
you.
me now, Adriana?
Yes, ma'am.
Can you hear me now?
Yes, ma'am.
Okay. Now I'm going to plug you back in the system. So actually, I shouldn't have to, I'm sorry. I shouldn't have to do that actually. Okay, so are you good now? I'm going to be writing on the board instead of using PowerPoint. So that's why I've got you right here.
Okay, thank you.
Okay, what was I saying? We're going to go over the chapter 4 homework. Finish chapter 5. There's some math that I want to go over with you all. And then we'll have a review for the exam. The chapter 5 homework will be due midnight on Friday. And the exam is Monday. And I have a study guide posted. We'll go over that in a little while. And then for the last, the remainder of the class, we're going to go over the portfolio assignment that's going to be due. So you're going to have the exam next week. Then the following week, those portfolios are due just for the contest. So hopefully you've been kind of looking at different stocks. There's always something interesting going on in the stock market. And so you may not have had a chance to research a lot of these companies in depth because it's just the way the class works. You really have to pick your stocks for the contest before you've done a lot of research. And so that's fine. You might decide that they're not the best investments after you've done the research when you do the report. But just to clarify or to remind you, there's two components to this portfolio. There's a contest where you're getting $10,000 of play money and you're going to have a portfolio of 10 stocks. It's a buy and hold portfolio, $1,000 each. And I'm going to show you tonight how to enter your portfolio in Yahoo. And then at the end of so what you're going to do in 2 weeks time on the 11th of October, you're going to turn those portfolios in class. And so I'll explain that later in the evening, but all you're going to do is print out a screenshot of your Yahoo portfolio. Then you just monitor it for the next couple months. Then on December 6th, you're going to print your portfolio out again, and the top 3 performers, the top 3 winners will get cash prizes, their gift cards. So you're not graded on how well your portfolio performs. That's not part of your grade. Your grade is on your research. So the second part of this assignment are these portfolio summaries where you're going to write a 1-page summary of each stock, and that's due on the 6th also. And we'll go over that in more detail later. But I can go over some of that if we have time tonight. But I definitely will show you how to pick your stocks and how to put those stocks in a portfolio in Yahoo Finance. Okay, so that's what we're doing tonight. Chapter 4, Chapter 5, review for the exam, and then talk about the portfolio contest, which is due in 2 weeks. Okay, so let's take a look at the Chapter 4 questions. And the Chapter 3 appendix that was due, that's just to get you used to doing those time value of money problems in Excel. Okay, so for number 7, the first question there is what differentiates a deductible IRA from a Roth IRA? So, and Adriana, you can speak up whenever, anytime you want to. So what differentiates a Roth from a traditional IRA?
When taxes are taken out?
Right, when taxes are taken out and if it's taxable. Because is a Roth IRA taxable?
We understood it was only taxable when you're paying into it.
Right, it's after tax dollars. So yeah, so basically when you're taxed is the way it's differentiated. So with a Roth IRA, you don't get a tax deduction. You're paying with after tax dollars. So if you contributed, let's just say you contributed $1,000 this year to a Roth IRA, or let's say you contributed $1,200. You set up a Roth IRA account and you contributed $100 a month, had it just taken out of your checking account. So at the end of the year, you've got $1,200. You've paid taxes on that. You didn't get any kind of tax deduction. It's after tax dollars. But the beauty of the Roth IRA is that you're never going to be taxed on that again, the way the current laws are. So you can invest that and make, you can invest it in really risky investments and make a lot of money on it. You'll never be taxed on it. So you're never taxed on the earnings. And then when you take the money out, you're not taxed either. With the traditional IRA, let's say you're contributing $100 a month, you get a $1,200 deduction on your taxes. So if you made $20,000, you can deduct $1,200 off of that. So your taxable income, say your taxable income was $20,000. After the IRA contribution, your taxable income would only be $18,800. You get to subtract out the $1,200. So you get that tax deduction. Then because you got that tax deduction, the traditional IRA, it will accumulate tax-free, or it's tax deferred. It accumulates tax deferred all these years. And then when you take the money out, that's when you're taxed on it. So you're taxed on your distributions at your current income tax level. So what conditions then would favor a Roth IRA? Or I guess a better way to, if you were confused by that question, a better way to word that is, when would you advise somebody to do a Roth versus a traditional IRA? Go ahead.
You could do a Roth if you're a low income earner, because you pay less taxes now than in the future. And if you're high tax, you probably want to do traditional to get the tax break now. If you expect to make less in time.
Exactly. So a Roth IRA, a traditional IRA makes sense if you're going to be in a lower tax bracket when you retire. And so like if you were a financial planner and you had a client who was in his or her 40s or 50s, let's say they were in their 40s and they didn't have a Roth, or they didn't have an IRA at all. You might recommend a traditional, because if they're a high earning person right now, they're going to retire in maybe 20 years, 15, 20 years, they will likely be in a lower tax bracket. So if you're sure that if it's a pretty good possibility that somebody will be in a lower tax bracket when they retire, then it makes sense for a traditional IRA. Other than that, though, it doesn't make any sense at all for a traditional IRA. And for most of us, it doesn't really make sense because you can't predict the future. And how do we know what tax bracket we're going to be in? The idea, the traditional idea is when you retire, you're not earning as much money, so you'll be in a lower tax bracket. But here's the deal. If you have saved for a long period of time and you've got a lot of savings, a lot of investment income, you might not be in a lower tax bracket. And also with the high deficit that we currently have, the federal deficit being so high, higher taxes are in our future. Taxes are probably going to go up. So why gamble with that? The chances are you'll probably be in the same tax bracket or maybe even a higher tax bracket when you retire. So that's why it makes for most of us, it makes sense just to do a Roth. The only reason, like just to repeat this question, the only reason only favorable or unfavorable for a Roth would be if you're going to be in a lower tax bracket when you retire. The other thing is with these traditional IRAs, I'm sorry, the only thing that favors a traditional is if you're going to be in a lower tax bracket when you retire. The other thing is if you are eligible to be in a company sponsored retirement plan, you can't have a traditional IRA. You can't get the deduction. So the deductible IRA, the traditional IRA, is only available to people who don't have a company sponsored retirement plan. Most of us do. And so there again, the Roth IRA makes sense. And so what a lot of, just to repeat this, I probably mentioned this last week, but what a lot of people are confused about is they think that, well, a Roth IRA is just like a savings account where you go to a bank or you go somewhere, you open up a Roth IRA and you're just putting in this money and it's just, you're just saving money, just earning some interest. That's not true at all. A Roth IRA or a traditional IRA, that's just the way the account is coded. You can open an account at Fidelity, you can open an account at Schwab, any of these brokerage houses. I don't think Robinhood has Roth or IRAs, but I'm not sure. Does anybody?
No,
They don't.
They're about to start offering a crypto wallet.
I saw that and I deleted that email immediately when I saw that. Between the emails that they were bombarding me with over the weekend about the crypto wallet, China came out and said, well, this was last weekend. China came out and said all cryptocurrency is illegal and they banned it in their country. So I'm kind of negative about crypto, but anyway, I thought that was kind of interesting that they're doing that. Be interesting to see what happens with the cryptocurrency. So now you can buy stocks instead of giving actual money to Robinhood. You can deposit cryptocurrency and buy stocks with crypto pretty soon. So anyway, getting back to the Roth IRA or traditional IRA, it's just how the account is coded. And so you can invest in whatever you want to with an IRA. You can put it in mutual funds, exchange traded funds, you can put it in stocks, whatever you want to do. So, okay, so anyway, that's 7. Okay, and then for number 9, does the efficient market hypothesis suggest that an investor cannot outperform the market? Okay, so what's the answer to that question? So does the efficient market hypothesis suggest that we cannot outperform the market?
No. It says it can't outperform the market consistently.
Right, that's true. That's true. We can outperform the market for a short period of time, but not consistently. You're right. So a lot of times when you'll read these gurus or you read about these people who they've written books or they have these newsletters you can buy or they're trying to sell you something. Usually the situation is they have outperformed the market, but you have to ask yourself, why did they outperform the market? Do they actually know something that we don't, or did they just get lucky? And most of the time, well, pretty much all the time, they just got lucky. They got lucky and they timed something right, and they're riding on those laurels, and they're writing, they've written a book or they've got some kind of newsletter or something, or some blog or something that they want you to pay for. And so I always ask myself, because these people are out there everywhere, you're going to see them. And I always ask myself, if you were such a good investor for a consistent period of time, why are you devoting your energy to try to get people to pay $14.95 a month or $20 a month to subscribe to you? That's because you got lucky, and that's where you're making your money, is off of these subscriptions. So the efficient market hypothesis says that you cannot beat the market for a consistent period of time, but you can do it for in the short term. All right, what effect does the dissemination of information have on efficiency, and how rapidly do securities change in response to new information in an efficient market? Okay, so what effect does information have, and how rapidly do prices change? Ready? Let's see. Cody, where's Cody?
Right here.
Oh, I'm sorry. You've got, I was trying to call on someone else. Sorry. Austin, where's Austin? Austin.
With that, responses are rather quick and by the time most investors know the information, prices have already changed.
Right. So the information, the availability of public information causes these prices to change really quick. So theoretically, once the information is out there, the price should immediately change. And so what I was mentioning last week was, let's just say that this company has an earnings report. So let me see what happened. Trying to think of what's been in the news. So this morning on the way in here, on the way to Nichols, I was listening to the CNBC, and they were talking about the cruise lines. The cruise industry, I think they were talking about Carnival. Carnival just reported their earnings. The cruise industry has lost like $2 billion. Carnival's lost billions of dollars. These cruise lines are way in debt because they're trying to get through all the COVID stuff. But so they had an earnings report, Carnival did. They gave all this bad information, but then they said that their bookings for spring of 2022 or something are way up. So the stock went up on the investors viewed that as positive news. So Carnival was coming along like this. And what should happen when a company reports good news should immediately see a spike in the stock. And then this is the new valuation. So this is, if the market's efficient, this is what should happen. But this is what happens sometimes. Sometimes there's an overreaction to the market. Well, instead of looking like that, sometimes you have this overreaction where the stock is coming along. It goes way up on this good news. People are rushing to buy it. There's an overreaction. And then it steadily comes back down to where it's supposed to be. So, and then other times there can be, if there's bad news, of course, when there's bad news, it should go like this, but you can have this overreaction on the downside and then it comes out. So what I have found is that, of course, if you have good news about a stock, then the question is, okay, when should I buy this stock? They have this good news. The stock price went way up. Am I too late, or is it going to come down, or will it continue to go up? Same thing here. If it's a good company and they have some bad news and the stock has gone down, should you buy it here? Should you wait? Well, this is what I found over all the years that I've been analyzing this stuff, is this is what typically happens. Sometimes the stock on bad news. There's bad news, the stock price goes down. Then if you wait a few days, what happens is these analysts will come out and they'll downgrade the stock. So these analysts will come out and they'll say, oh, well, they're downgrading the stock, like the price target, or meaning the value, or they'll say they're downgrading it, say, from a buy to a hold. So a lot of times what I'll do is I'll put some money in, but then I think it might go lower. So just in case it goes lower, if it's downgraded and so forth, I'll wait, and then if it goes down further, I'll buy some more. And so I've been trying to be more patient. Instead of, if I want to buy something either up here or here, instead of going all in, I'll say, okay, well, I'm just going to buy, like, put a third of my money in there and then see what happens. If it goes higher, it went higher, I'm making money. But if it goes lower, then I can buy more. So anyway, if it goes up like this, it could go back down, or it could continue to go higher, because a lot of times what happens, if it's not an overreaction, they'll get upgraded. So anyway, but my point is, the markets are efficient overall, but you can still have these overreactions and underreactions. And then also what's really interesting too is if you're waiting for economic news, like the Michigan Senate report or some news coming out from Washington, and you're waiting to see how it affects the market in general. Well, you can see, like, let's say that the announcements come out at 10 o'clock in the morning. sometimes you can see the market kind of change right before that, like 5 minutes before the market's changing. Then the news comes out and it continues to go the same way. So there's some unethical behavior going on. So what I'm saying is some people are leaking that information sometimes, and they're trying to capitalize on it beforehand. So anyway, the markets are efficient, meaning that with publicly traded, with publicly available information. So that leads us into the number 10, what are the three forms of market efficient hypothesis? What are the three forms of efficiency? So what are the three forms? Anybody? Right, so we have the weak, semi, and strong. Okay, so the weak form saying all historical information is reflected in the stock price. Okay, the markets are efficient in the weak form. We have the strong form, which that's the publicly available information, historical plus the publicly available info, that's semi. And then the strong form is saying that all private information, inside information is reflected in the stock price, which of course we know that not to be true, that if people have inside information, you can capitalize on that. And so the Securities and Exchange Commission, they're so outnumbered, so to speak, they're underpaid and outnumbered that they can't possibly investigate all this stuff. They can flag your account if they think there's suspicious activity. So let's say, for example, that a company made an announcement and I just happened to buy that stock a few days prior. They might flag my account and see if there's a pattern of behavior, because they're going to say either she got really lucky or she's trading on inside information. And so they might that's how they catch people. They'll flag people's accounts and then they'll watch them. Then they'll look and see what does this person have relatives in the business, or do they work for this company? If you work for a company, you're actually restricted. You can only buy and sell the stock at certain times. So I'm trying to think. There's been some interesting cases. Did I tell you the one about the pharmaceuticals? So let me tell you this real quick. So this guy, and also you have to think, how stupid can these people be that think they won't get caught? So this guy and his son, they had like 3 or 4 separate brokerage accounts, over $500,000 in each one. They were making a ton of money, and they were making money mostly in these pharmaceutical companies. So the SEC starts investigating, and they find out that the father works for the FDA, and the father had privy to the software from the FDA, and he could see when drugs were going to be accepted or rejected before it was announced publicly. And so he had set up these accounts in his son's name, and adult son, and they were trading on the good news and shorting on the bad news. So they caught him eventually. But anyway, there's all kinds of little cases out there, and people will try to capitalize on good news and inside information. But sometimes it's a matter of timing, and I'll give you this one example. When I worked as a financial planner, one of my colleagues, this was back in like 2001. We had there were a lot of these scandals that had come out, Enron scandal, these accounting scandals and so forth. And so my coworker just jokingly says to me one morning, he says, "Sherry, there's this publicly traded bank in Alabama." He had moved from Alabama. He said, "My girlfriend's still working in Alabama, in Birmingham, and there's this bank, and the accountant just committed suicide." He said, "I think there's some kind of scandal that's going on with that bank." And so I was just joking around. I said, "Oh, you should go get a loan and short that stock." This was like in February. And so then like a couple months later, I asked him, I said, "So what's going on with that stock?" And he said, "Oh, they had an earnings report and they went up like 5%. So the stock was trading higher." like 3 months later. And so then, so I said, okay, well, it's good you didn't try to be dishonest and capitalize on that. And then fast forward all the way to around September. Okay, so over 6 months later, the story finally hits that there's this accounting scandal and the stock goes way down. So my point is, even if you're trying to capitalize on what you think is inside information, the timing might not be there, or you might be totally wrong too. A lot of times people will get information about some drug that's going to be accepted and it's not approved. And so anyway, it's best not to try to do those things, because the SEC can find you and come after you. And there's plenty of money to be made in the market, the honest way. Okay, so that's the 3 forms of efficient market hypothesis. So there might be a short answer question on the exam dealing with efficient market hypothesis, maybe a short answer question dealing with IRAs, Roth versus traditional IRAs. Okay. Any questions? Okay. Let's see. Okay, let's take a look at, we finished chapter 4. Let's take a look at chapter 5. Now, do you all have your books with you, or do you have the ability to pull up the textbook on your computers? Yes, yes. Okay, go ahead and get your laptops out, because it's easier. It's easier for me to go over this. I want to go over a couple examples in the book that aren't in the slides. Okay, so if you look at figure 5.4, in chapter 5, we're talking about risk and return. So what do we mean when you think about risk? When you hear the term risk, what do you think of? What does risk actually mean when you're investing? What does risk mean?
It's how much money you can possibly lose on your investment.
Right, it's the possibility of low returns or negative returns. So the riskier the investment is, the greater the possibility of, or the probability of, negative returns. So let's take a look at this chart here. So let's say that I bought a CD. Let's say I put my money in a certificate of deposit, a CD, and it's paying 3%. The graph would look like that because I'm guaranteed 3%. There's no variability there. Okay, but what if I invested in a stock with an expected return? And I'm going to show you how to calculate this in a minute. But let's say the stock had an expected average return of 15%. Okay, well, this is my, let's say that the expected return, I'm going to say ER, is 15%, and the standard deviation is 10%. Okay, so remember back, do you guys remember the empirical rule? Anybody from finance or from QBA 282 and 283? Yes, yes. Yeah, okay. So the empirical rule basically says that it's, if you have a symmetrical distribution that, what is it, 60, it's 64, 95, and 99. I think it's 64. That's 64% of your standard deviations are going to be within, 64% of your observations will be within one standard deviation. 95 will be within 2 standard deviations, and 99% will be within 3 standard deviations. So basically, if we, let's say that the standard deviation for this particular stock, this is stock A, the expected return is 10%. So that means that I calculated this weighted average, and over the years, some years I'll make more, some years I'll make less, but over the years, I can bank on making 15% in this investment. But the standard deviation, the variability of my return is 10%. So if we use the empirical rule, that's saying that we basically have a 64% chance that I'm going to make 15%. This is +1 standard deviation. This is -1 standard deviation. So I have basically a 64% chance that I'm going to make 15% plus or minus 10%. So if I, so with a standard deviation of 10%, I could make, if I'm within one standard deviation, I could make as much as 25% in 1 year, or I could make only 5%. So I'm just taking the 15% plus 10% and the 15% minus 10%. Okay. If I'm within 2 standard deviations, I could make as much as 35%, or I could go negative, could make -5%, lose 5%. If I'm within 3 standard deviations, and virtually 99.7% of my observations are going to be within 3 standard deviations, I could make as much as 45% with the stock, or I could lose 15%. So this particular investment has a range with a standard deviation of 10%, has a range of -15% all the way up to 45%. Now, what if I had this investment like this? If my let's say this is stock B. B still has an expected return of 15%. But which stock is riskier, A or B? Which one would you prefer? Which stock is riskier? Right, B is riskier because it has a greater variability. So it's more spread out. So let's just say that the standard deviation for B is 20%. So I could make, for B, I can make 15% plus or minus 20. So this would be 15. This is going to be 35. This will be 55. This is 75. This is going to be -15, -35, -55. So B is riskier. So the greater the standard deviation, the more variability we have around the mean. And so there's 2 ways to measure risk. Standard deviation, that's what they talk about at the beginning of the chapter. And then towards the end of the chapter, they talk about using something called beta to measure risk. So that's the expected return. That's the standard deviation. So let's take a look at that. So that's just a graph that they're showing in figure 5.4. So let's look at page 1 on your ebooks. Do you have the page numbers? Does it give you the page numbers on? Okay, so if you look at this just after 5.4, let's see. Go ahead and look under the section where it says the return and standard deviation of a portfolio. So it has these, well, I'll write these numbers down for you. So let's say that we have this situation. So we have three stocks. And these are the returns. We have a portfolio here. The first stock is returning 8.3%. The second stock is returning 10.6%. And then the third stock is returning 12.3%. And the weights are so I've invested 50% of my money in stock 3 and 25 in the other 2. Okay, so we're going to calculate the expected return for this portfolio. So the expected return is simply the sum of each weight times the return. So we're going to take, so the way we calculate that is we're going to take the expected return then, it's going to equal 8.3 times 0.25 plus 10.6 times 0.25 plus 12.3 times 0.5. So when you calculate this, you can leave, obviously these weights have to be in decimal form, but your returns, you can leave them like this if you want to. If you put your returns in decimal form, then you just have to move the decimal back to the right 2 places to put it back in percentage form once you finish. So anyway, if you calculate this, 8.3 times 0.25 is 2.075 plus 2.65 plus 6.15. So we end up with 10.875 is our expected return. So if we had this portfolio, we could expect a return of 10.875. Okay, any questions on the expected return? Okay, so that's how you calculate the expected return. So next we have the standard deviation. So you may or may not remember when you took Finance 302, the standard deviation of a stock was the sum of each of the return in each state of the economy minus the expected return squared times the probability, and you would take the square root of this. Okay, well, for this course, in this chapter, we're not doing it this way, because you really can't, when you have a portfolio, you're trying to calculate the standard deviation of a portfolio, it gets really complicated trying to do it this way. So we're going to use a different formula for, in order to calculate the standard deviation of a portfolio. So first, before we do that, there's a couple of things we need to talk about. There's the correlation and there's covariance. Okay, so the correlation coefficient, does anybody know what the correlation coefficient is? Well, the correlation coefficient basically tells us how two stocks will move together, or how various stocks move together. And the range goes from 0 to +1. So if you had two assets, two investments, and they were perfectly positively correlated, what would that mean? If they had a correlation coefficient of +1, meaning they moved completely together, perfectly positively correlated, what would that mean for you as an investor?
It wouldn't matter which one you pick.
It wouldn't matter, right? It wouldn't matter which one you pick, and how am I doing for trying to reduce my risk there? Not,
You haven't reduced it
I haven't reduced it at all, right? So now when we have a diversified portfolio, it does reduce your risk. And so what some people will say, which isn't true, but some people will say, well, if you're diversifying your portfolio and you're reducing your risk, aren't you reducing your returns too? And they argue, if you reduce your risk, you're reducing your returns. But that's not really true, because when you have a diversified portfolio, your average return could go down a little, but your risk goes way down. So like if you have two stocks that are making, a return, but when you average it, the return is going to be the average. But the standard deviation isn't the average. The standard deviation goes way down depending on how the correlation is. So if you have two stocks that are perfectly positively correlated, you're not getting any diversification benefits at all. So if I could predict the future, then I would do that. I would get stocks that were perfectly positively correlated. I could buy them when they're low, wait till they go up and sell them. If I could time the market and predict the future, then I could do that. I would just buy two stocks that are perfectly positively correlated, have that in my portfolio, and buy low and sell high all day long. But I can't do that. I need to diversify. So the ideal thing is to be way over here. If I bought stocks that were perfectly negatively correlated with one another, that means when one is up, the other's down. If I could get things that were perfectly negatively correlated, then I could pretty much guarantee a certain return. Maybe it won't be as much as if I was picking, if I was able to predict the future, but I would eliminate all my risk, is my point. I would have zero risk. I would be guaranteeing myself a return. Now, so a correlation coefficient of +1 means that stocks are perfectly positively correlated. A correlation coefficient of -1 means that they're perfectly negatively correlated. 0 and anywhere in between is either some degree of positive correlation or some degree of negative correlation. 0 means there's no relationship at all between the two stocks. There's no correlation at all. So the market in general has a correlation of about +0.65. That's the market, the stock market in general. So it really is kind of hard to find things that have a negative correlation. So thinking just off the top of your head, what are some stocks that you're thinking about putting in your portfolios? And do you have any stocks that you think are you trying to, in your portfolio, if you've had time to think about it yet, are you trying to just pick all stocks that are going to be high flyers for the next 2 months? Or are you trying to be diversified? And if you are trying to be diversified, what kinds of stocks are you thinking about putting in there? Anybody?
I was thinking of adding a lithium
Cody?
ETF.
A lithium battery ETF? Okay,
Lithium and mineral, but yeah,
okay, all right, because of the solar batteries and all that?
Yeah.
Okay,
and electric car mandates and everything.
okay, All right. I've been thinking about the Tesla a lot. Every time I see a Tesla on the road these days, I think about, I'd really like to stop and ask those people, how'd you make it through Hurricane Ida? What happened to your electric car during the hurricane? Because I've always said that's the big problem with an electric car down here. What are you going to do if you have to evacuate and you're sitting in traffic for hours? What are you going to do if you go a month without electricity? Go buy gas for a generator and charge your electric car? It's crazy. Do any of you know anyone who has an electric car? I don't either, but I'd love to ask them. Do you?
My neighbors.
And what'd they do? Set in the garage?
They have solar panels, but they also had a generator. So I don't know if they have
A whole house generator or a regular?
it's like that.
Oh, gas. Well, that's odd.
Yeah, I don't know. He's a weird guy, that's it.
Okay, interesting. Okay, so let's talk about some things that might have a low correlation. So for example, y'all familiar with Dollar Tree, right? During the last recession that we had, 2007, 2009, some stocks were down as much as 50% or more. The NASDAQ index was down 50%. A lot of stocks were down 50%. Dollar Tree actually went up. Dollar Tree, Dollar General, those kinds of stocks, those stocks actually were positive. Why? Because everyone was going, trying to get cheap stuff and going to those stores. Yes.
And in some parts of America at the time, Dollar Generals and Dollar Trees were the only places some rural Americans could get groceries.
Right, right. So, I travel a lot. My husband and I will drive around and travel a lot, take little side trips when I'm off work. And it amazes me how these little towns you can drive through a town with nothing, but there'll be a Dollar Tree, there'll be a Dollar General there. It's kind of crazy. And so they really have grown a lot. So anyway, the point of diversification, if you think about things that have low correlation, that can really help you in the long run in your portfolio. So Dollar Tree's one. Thinking of another one, McDonald's went down about 20% when everything else was down about 50%. So that's a good one. They also call and as you're doing research for your stocks as to what to pick, you could Google this, defensive stocks. I don't mean the defense industry. I mean stocks that will do well or don't do as poorly when the market has a downturn. So think about this. If we go into a recession or if the market takes a correction, the economic growth is down, what are people still going to do and what are they still going to buy? What behaviors probably won't change? What kind of companies are recession proof? Okay, probably. Alcohol, cigarettes, Coke, Coca-Cola, pot stocks, probably. Those are new ones, the Tilray and those pot stocks probably would be recession proof. Oil, yeah. So energy stocks are recession proof. So after, energy has been down and up and down, and there's this ETF. You might want to add this to your portfolio. This one's really interesting. I don't know if I mentioned this before or not. It's called OIH. It's an oil services ETF. So like Baker Hughes is in there, Halliburton is in there. Trying to think of some other company. No, it's not any oil companies. It's oil services. Schlumberger. I know Schlumberger's in there. So anyway, you can buy oil companies, energy companies and stuff, but this ETF is kind of cool. So this ETF, about 3 months ago, it was in the doldrums for a really long time. It was at like $204. I bought some at $204. It went all the way up to like 240 in a few months. And then OPEC started with their nonsense about a month ago. It went all the way down to like 180. It was ridiculous, from 240, 230, 240 to 180. So anyway, I had bought and sold it when it was down here. And I bought some at like 186 after the storm, because I was thinking, you got this hurricane, this huge hurricane that's hit. Most of the energy coming into the US comes from Port Fourchon. And that you're probably going to have this increase in demand for oil. There's going to be restricted supply, blah, blah, blah. So anyway, sure enough, today, oil's up 5%. Oil, I don't know if oil went up 5%, but OIH went up 5% because oil is up because there's some issues in the Gulf, and with the hurricane, they're worried about the supply. So those are, the point I'm making there is those are advantages. Those are situations that you can take advantage of. And so, for example, with the hurricane, oil prices do tend to go up after hurricane. Home Depot and Lowe's, those companies tend to really do well after a hurricane. But every time I look at them, they're up. So I haven't had a chance to buy those. But anyway, getting back to defensive stocks, what are people still going to do regardless if there's a recession? They're still going to smoke. They're still going to drink. They're still going to buy soda, still buy pot when where it's legal. They're still going to buy gas. They're still going to shop at Walmart, maybe even more so. They'll probably still go to McDonald's. They will still buy medicines. So Johnson & Johnson, any of these pharmaceutical companies, those are examples of what we call defensive stocks. Kraft, the Campbell's, those kinds of companies as well. So not as much so in the foods, because people will go to discount to the store brands. But so if you are, Heinz is another one. So if you think about a Rubbermaid, that's another one. So you can Google that and get some ideas on defensive plays. So those are some ways to diversify your portfolio in a way that will get you down around here. Also, I mentioned this before, I think in class, REITs. These are exchange traded trusts that are invest in real estate. A REIT is a real estate investment trust. And so they're investing in shopping centers, apartment buildings, real estate. Well, these REITs tend to have a low correlation with the market. When the market's way up, they're not up by as much, but when the market's down, they don't go down by as much. And so that's also a good way to diversify. Okay, Cody, you bought a lithium ETF?
I was looking, I'm in the process.
Oh, you're in the process, but precious metals are also can also be a way to diversify your portfolio, because what's supposed to happen is when everything else is going to hell in a handbasket, when there's really bad news out there, gold and silver tends to go up. And so you can buy a gold ETF or a silver ETF to try to diversify your portfolio. Just that's not always the case though, and it can be volatile, but it's interesting. So here's some other things to look at. GLD, that's the gold ETF, and SLV is the silver ETF. Okay, so that's the correlation coefficient. Ranges between -1 and +1. Your goal is to have a correlation of -1, but that's not really possible. You can get there by buying defensive stocks and offsetting that with some growth companies, and then maybe buying some REITs. Now you can also buy individual stocks that are real estate trusts, like Joe, for example. This is a company out of Florida that invests in real estate. BXP is another one. I think it's BXP. That's Boston Properties. Those are a few examples. Okay, so that's the correlation coefficient. Now there's another metric in the book called the covariance. We need, you have to have the correlation coefficient to calculate the covariance in the way they're doing it in the book. The covariance is basically, it doesn't tell you, it tells you whether the these two assets are positively or negatively correlated. So in other words, the covariance doesn't tell you by how much they're correlated, but it'll tell you whether it's positive or negative. So for example, if you had a covariance of positive 10.1 and then another covariance of positive 0.2, it doesn't mean that the one is twice as much correlated as the other. So the magnitude is meaningless. The covariance only tells you what the sign is. So with the covariance, we're just interested in the sign. If the covariance is positive, it means that we have a positive correlation. If the covariance is negative, it means we have a negative correlation. Then we use what we really want to look at is this correlation coefficient, because that tells us how much the correlation is, whether it's perfectly positive, perfectly negative, or somewhere in between. All right, so we're gonna take a break in a minute. But when we come back from the break, we're gonna look at figure 5.5. And we're going to go over these three cases. Case 1, perfectly positive correlation, okay, portfolio. Case 2 is perfectly negative correlation between these two stocks. And then case 3 is just kind of like a low positive correlation. And so we're going to use these formulas that are in this chapter to calculate the standard deviation of these different portfolios. Okay, so let's take a 10-minute break, and then we'll come back and do that. Hey, you called? Does anybody have a printed version of the homework? Yes. You can, just do those in Excel.
Oh,
We did. There,
you care if that's well, so,
okay.
if it doesn't,
No, I did not care. Do some teachers care?
yeah, there is some.
Why would they care? They have way too much time on their hands. So I was listening to the news driving in today, and they were saying that there's still 5,000 people in the parish without electricity, Terrebonne and Lafourche, which is a lot. It's 4 weeks to the day of the recovery, and there's still 5,000 people without power. Crazy. Okay, so if you look at figure 5.5, if you take a look at figure 5.5, we're going to see these three cases. And we've got case 1 where stock A and stock B are perfectly correlated. So the portfolio is just, it's going to be the same as investing, no difference between investing in stock A and stock B. Case 2, we have perfectly negative correlation, so you're guaranteed a certain return. And then case 3, where you have this somewhat a low positive correlation. So what have we talked about so far tonight? We talked about the expected return, we talked about the expected return, and then we talked about correlation and the correlation coefficient and the covariance. So now I'm going to show you how to calculate the standard deviation. So this is the formula for the standard deviation. And of course, the standard deviation tells us how risky a portfolio is. So the standard deviation equals the square root of the weight. So this is the standard deviation between a 2-stock portfolio. If you add more than 2, it gets crazy. So it's going to be the weight of stock A squared times the standard deviation of stock A squared plus the weight of stock B squared times the standard deviation of stock B squared plus 2 times the weight of A, the weight of B, times the covariance of A and B. Okay, so for the exam, you'll definitely have a problem like this. You can use a formula sheet. So you can bring in, you won't need a full page, but you can bring in a one-page formula sheet from that. So I'm not interested in making you memorize these formulas. Just, I'm more interested in that you can explain what the meaning of these things are. Okay, so that's the code. That's how you calculate the standard deviation. Now, you also need the formula for the correlation coefficient. I really don't like these loose leaf books. I lost my page just a second. Here it is. Okay. The formula for the covariance of A and B is the standard deviation of A times the standard deviation of B times the correlation coefficient of A and B. Okay, so these are the formulas you need to know. How to calculate the standard deviation, how to calculate the covariance, because you need that for the to calculate the standard deviation. The correlation coefficient will be given. And then the expected return, the way you calculate the expected return, that is just the sum of the weights times the individual returns. That's what we did earlier. So those
Can you
are,
pick the camera back up, please?
Sorry.
That's okay.
can you see the board all right? Sort of.
Yes.
Okay. Okay, so these are so make sure you study these formulas and write them down from the chapter. Expected return, standard deviation, and covariance. Okay, let's look at this case then. Let's look at case 1 first. Okay, so in case 1, it's a perfectly positive correlation situation. So if you look at case 1, it's on page 149. We have 4 years of returns, and we have the average return. And we have the standard deviation. And we have stock A, stock B, and the portfolio. Okay, so here's the returns. We have a 10% and 10% minus 12. Okay, so we're going to calculate the standard deviation of the return of the standard deviation of the portfolio. All right, so with this situation, this is case 1. This is going to end up to be 27.16%, but I'm going to show you how. Because obviously, if the two stocks are perfectly positively correlated, if they're identical, then the portfolio returns are the same and the standard deviation is going to be the same. You're not going to get any reduction in standard deviation by investing in these two companies. So let's calculate, using the formula though, let's calculate the standard deviation. Okay, so let's come over here. So the standard, let me write this down again. So the formula for the standard deviation is going to be the square root of the weight of stock A squared times the weight times the standard deviation of stock A squared plus the weight of square root of B, standard deviation of B, plus 2 times the weight times the covariance of A and B. Okay, so these are 50-50 portfolios. So the weight is 50%, so it's going to be 0.5 squared times 27.73 squared plus 0.5 squared times 27.73 squared plus 2 times 0.5 times 0.5 times 27.73 times 27.73 times -1. Okay, and the way that you get the correlation coefficient is, let's see here. Oh, that was given, I'm sorry, that was given to us. So they told us that obviously they're perfectly negatively correlated. So the covariance, this is actually a separate formula here for the covariance. Each standard deviation times the correlation coefficient. So anyway, when you do the math here, the standard deviation ends up to be, I'm sorry, the standard deviation, of course, is going to end up to be 0, equals 0. So because they're moving in, wait. Oh, this is, I'm looking at the wrong one. This is a +1. So the standard deviation is going to be 27.16. This is the wrong page. Okay, so anyway, if they're perfectly positively correlated, you're going to get the same standard deviation. Okay, now let's look at the next one where we have case 2. We have a perfect negative correlation. So let's take a look at case 2. So we have here stock A. So for this one, the returns are, this is on page 150. You have -15, 12, 25, -37, -3.75, and the standard deviation is 27.73. Okay, and then for stock B, you have a return of 25, -2, -15, 47, 13.75, and then 27.73. Okay, so in case 2, both of these stocks have the same standard deviation, same amount of risk, but they're perfectly negatively correlated. Okay, so let's see what happens to our risk when we combine these into a portfolio. Let's see what happens to our standard deviation. So our average return, the way to calculate the average return, you just take the average between these two. We end up with a 5% average return. So that's what I was alluding to earlier. If I could play my cards right and, and just put all my money in stock B, if I thought it was going to go up, then I could make 13.75%, but I can't time it. So I'm going to have this portfolio, and my expected return is going to be 5%. Okay, that's the average. But my my standard deviation is going to be much lower than this 27% because the correlation is low. So anytime you have a really low correlation, it really gives you a lot of, it significantly lowers your standard deviation. So let's put this in the formula then. Okay, so this is going to be 0.5 times, well, it's the same numbers, 0.5 times 27.73. The other one, I had the numbers wrong on the other one. It was 27.16. But anyway, this is the, if you look at page 150, it's 27.73. And then this is -1. So what happens is we end up with a standard deviation of 0. So we totally eliminated our risk because they're perfectly negatively correlated. So of course, that's not realistic. In the real world, we cannot find stocks, investments that are perfectly negatively correlated. It's more likely that we have either a low positive correlation or maybe if we're real lucky, maybe a partially negative correlation. So let's say that we bought Tesla and Dollar General. They would have a low correlation, probably a negative correlation. So let's take a look at case 3. So that's the situation with case 3, where we have a negative correlation, a partial correlation, but negative. Okay, so in this situation, we have the correlation coefficient is negative 0.524. Okay, so negative 0.5 is our correlation. And stock A is going to return, in year 1, stock A returned 10%, stock B returned 2%. In year 2, stock A returned negative 8%, stock B returned 12%. In year 3, we have 14% and 6%. In year 4, we have 4 and negative 2. And so our average returns here on the portfolio are 6%, 2, 10, and 1. And our average return for stock for those 4 years for stock A is 5%. For stock B, it's 4.5. So the average is 4.75. Now look at our standard deviations though. The standard deviation for stock A is 9.59%. The standard deviation for B is 5.97%. Now, when we put this in our formula, so we have here we have, we're taking the square root, 0.5 squared times 9.59 squared plus 0.5 squared times 5.97 squared plus 2 times 0.5 times 0.5 times the 2 standard deviations times negative 0.542. So we end up with a standard deviation of 4.11%. Okay, so look at what happened here. So this is more realistic. We have a partial negative correlation. Okay, we've got the average return here with this portfolio, 4.75%. But look at how much we've reduced our standard deviation. our standard deviation is lower than both of these. So we've got a significant reduction here in our risk by investing in two stocks that have a partially negative correlation. So this is a little more realistic. So the point is, the more you diversify, you're reducing your risk way down, but you're not really sacrificing your return. Okay, does anyone have any questions on the expected return, the standard deviation, covariance, correlation coefficient? Okay. Okay, there's another way to measure risk, and that is using beta. So beta is another way to measure risk. Greek letter beta, Greek letter B. So the market has a beta of 1. So if we're looking at a stock and a stock has a beta of 1, that means that it's just as risky as the market. So what the way analysts come up with the beta for a stock is they'll run a regression analysis, and they'll look at it's historical information. They'll look at how the stock performed in relation to the market. They'll look at, say, weekly returns over the last 5 years. And if this stock performs identical to the market, it's going to have a beta of 1. If the stock is higher than is riskier than the market, in other words, when the market's up, if the stock is up higher, when the market's down, if the stock is down lower, then it's going to have a beta of greater than 1. If it doesn't move quite as much as the market, if it's not as volatile as the market, it'll have a beta of less than 1. So some of these stocks, this is also another way to look at diversification, because like a lot of these REITs have negative betas. And so if you get a stock that has a really low beta or negative beta, that gives you some really good diversification benefits, because it tells you that it's not really moving with the market. So beta is another way to see how risky a stock is. So we use beta. Let me see if you guys remember this formula at all. So this really isn't covered too much in the book here. So you're going to be using this formula when you do your project with your for your portfolio project. So your analysis. So make sure that you make good notes and put a little star that just says you're going to use this calculation when you analyze your stocks. So I don't know how long ago you guys took Finance 302, but you should have learned the capital asset pricing model. And the capital asset pricing model basically tells us tells us what our required return should be for the amount of risk that we're taking. So it tells us what our required return is okay, so the capital asset pricing model tells us what our required return should be for the amount of risk that we're taking in the stock. Okay, so let me show you what this formula looks like. So the CAPM, the capital asset pricing model, is the required return. So our bar, that's the required return. So the required return equals the risk-free rate plus the return in the market minus the risk-free rate times beta. Do you remember that formula at all? Yes? Okay, good. It's an easy formula. And this stuff is, most of this stuff is given to us. The beta is given to us. The risk-free rate is given to us. The market return is given to us. And we just calculate the required return. So if we had, so let's just say that, no, the risk-free rate, that's the rate that you could get if you bought a CD. If you bought a CD or a T-bill, let's just say it's 3%. So the rate that you could get by investing in a risk-free investment, a CD, let's just say that's 3%. We're going to put in these assumptions. The risk-free rate is 3%. The return in the market is, let's say 12%, because that's the historical return in the market is 12%. So we're going to use those assumptions. Now, if we had a stock that had a beta of 1, we would get the market return, right? If the 1 is the market, and we're saying that the market return is 12. If I plug all these numbers in, the required return for a stock with a beta of 1 is going to be 12%. It's the market return. So let's plug those in just to see. So if we had a stock with a beta of 1, the risk-free rate is 3%. The market return is 12%. Here, the risk-free rate is 3%. So you take, and this, let me show you. This actually is called the risk premium. Here's why. The market return is 12%. The risk-free rate is 3%. If I'm going to be induced to invest in the market, I want to make this is how much more I want to make, 9% more. So that's the risk premium. In other words, if I could get 3% in a risk-free investment, but I could get 9% by investing in the market, the risk premium for investing in the market then is 9%, the difference between the two. Everybody see that? Okay, so if we do the math here, 12% minus 3% times 1 is 9. 9 plus 3 is 12. So the required return on an investment with a beta of 1 is 12%. Okay. Now, what if you invested in a stock? Let me ask you this. What is the required return on a stock with a beta of 2? It's not going to be double the way this formula works, because this is the only part that doubles. So a lot of, when you're looking through your companies for your portfolio, look at the betas. I'm going to show you later in Yahoo how you can find all that information. And you might, if you pick some mining companies or some, trying to think of the word, some transport companies, like some of these companies that some shipping companies. If you pick some shipping companies or some mining companies, especially these shipping companies, they tend to be really risky. You'll probably find a beta of 2 or maybe even 3. It's really crazy. Look at the pot stocks and see what their beta is. That would be interesting to see. You could also Google high beta stocks and see what comes up. So obviously the higher the beta, the riskier the company is. So let's see what the required return would be on a stock that had a beta of 2. So let's put 2 in here. So 9 times 2 is 18. And then 18 plus 3 is going to be 21. So if we put, using the capital asset pricing model, assuming that these assumptions are correct. Now, of course, these models, like any model, they're only as good as their assumptions. So if we're assuming that it's correct that the market return is 12%, the risk-free rate is 3%, then what is the required return if I'm going to invest in a really risky stock with a beta of 2? My required return would be 21%. Okay, any questions? Okay, so what I'm going to show you now is how we can compare the expected return to the required return. So one way to see if the stock is undervalued or overvalued is to compare the required return to the expected return. So you can calculate the required return using beta, and the expected return is just what the analysts think it's going to do next year. And so when you're looking at once you've picked out your stocks, when you're doing your one-page analysis of each stock, what I want you to do is to calculate the expected return and then calculate the required return and compare the two. That's one way to see if the stock is undervalued or overvalued, if it's a good buy or not. So let's look at an example. So I'm going to, see, I need to reconnect this and share the screen with you guys. Hang on a second. So Adriana, she's still there.
Yes.
Okay, I'm going to share the screen in Yahoo. So you're not going to be able to see the board and the screen. So just try to listen to what I'm saying. And
Okay.
if you have some questions, you can call me my office during my office hours.
Okay.
Or I mean, you can call me anytime. You've got my cell number and that. Can you see my screen?
Yes, ma'am.
Okay, while we're waiting for that to come up, I'll pull up.
I actually can see the board and the screen.
Okay, good. Well, I can't get it to come up for the class. Hang on a second. Why don't you, let's take one more quick 5-minute break, and I'm going to try to get this technology to work. There it goes. Okay. Okay, do any of you have a stock in mind, or have any of you started to think about stocks? Somebody pick a stock. And we'll use it as an example. Corsair? Is that an airplane?
It's
Engines?
like computer hardware.
Oh, computer hardware. Okay. Okay, what's the ticker for Corsair?
I think it's CRS.
CRSR. Corsair Gaming?
Yep.
Oh, is that like FanDuel? Oh, you mean it's video gaming?
Yeah, like
They make performance parts for gaming PCs,
like mice, keyboards.
Oh, okay.
video cards.
Oh, interesting. Okay. This is an interesting company. Okay, so let's check. Whoops. What's the ticker again?
CRSR.
Okay. Okay, so here's Corsair Gaming. And so let me just show you this. Use Corsair as an example here. For your, I'm kind of intertwining the projects with this example. You might also have these two questions on the exam too, so I'm kind of intertwining the two. So anyway, here's Corsair. So this is your summary sheet. They haven't calculated a beta for this company. This must be a new company.
Yeah, I think they IPO'd last year.
Okay. Well, this isn't gonna work for us then, but let me just explain some things that you can get from Yahoo. So look how they think it's undervalued. Here, they think it's undervalued. The volume, the volume was low today. This is the average volume, almost 2 million shares traded on average. This is what it is after hours. Oh, this is after hours. You can actually, really crazy people actually trade after hours too. It was down 11 cents today. Here's the 1-year target is $39.67. So it is undervalued. Okay, we got to pick another one though that has a beta. So anybody?
IBM.
Okay, IBM's good. Okay, so we're going to calculate the expected return for IBM. Now, the way you calculate the expected return is you look at, we're going to calculate the capital gains yield plus the dividend yield. So the way you calculate the capital gains yield is you come here to the 1-year target. Now, this is the average of what all these analysts out there think the stock is going to be. Now, if you go into analysis here, you're going to see all of what all the analysts think, and you're going to see a huge price range. For a lot of stocks, you'll see a huge range. So again, all this comes down to, you probably know as much as the analysts. You're going to see a big diversity there. And so somebody at the low end would not think it was a buy at all. Someone at the high end thinks it's a great buy. But we're going to take the middle, the average. So the average, the 1-year target is $150. So we're going to calculate the capital gains yield, $150. How much we're going to make if we buy it today. We would have bought it today at $138.56. And then it pays a dividend. And let's do the forward dividend yield. It has a 5% dividend yield, almost a 5% dividend yield there. So remember, the dividend yield is simply the annual dividend divided by the price. And they calculate this for us. Okay, so let's come up here to the expected return. So the expected return is the capital gains yield. That is the current price minus, I'm sorry, it's the year-end price or the 12-month price. Let me change this to 12 months so you won't be confused. It's the 12-month price minus the current price divided by the current price. And then, so we're going to calculate that, and then we're going to add the dividend yield. So the current price is, the year-end price is 150, or 1-year price. So we're going to take 150 minus 138.56 divided by 138.56 plus 4.77%. That is our expected return. That's what the analysts think this stock is going to return in the next 12 months. All right, so let's see here. So
Where you get that number that you're adding?
this?
Yeah.
Right here, the dividend yield. Right. Forward dividend and yield. Right here. So in other words, I'm going to make this off of the dividend. I'm going to make this off my capital gains. Add them together, that's my total expected return. So 150 minus 138.56 divided by 138.56. That's 8.26%. Okay, so my expected return is 13.3%. that's not bad. I really kind of, I like the idea of IBM paying such a good dividend, because the thing is, whether the stock goes up or down, you've got this 4.77% dividend you're really getting. You can't get that anywhere. Think about that. You can't get that anywhere in CDs or anything. So this is another reason why the market has been doing really so well, with the exception of the COVID blip. The stock market has been doing so well because interest rates are so low. There's nowhere for people to put their money and make any money. And so some people are really migrating towards these higher dividend yield paying stocks. And you'll see as you start to research different companies that this is a pretty good dividend. Okay, so anyway, the expected return on IBM, 13.03%. Now let's calculate the required return. Based on IBM's risk, how much of a return should we be requiring to be compensated for our risk? So let's do the required return now. So the required return is going to be 3% plus. Now remember, I just made up these numbers. I mean, I didn't just make them up, but these are good assumptions. We're assuming that the risk-free rate is 3%, and we're assuming that the return on the market this year is 3%, because that's what the historical average is for the market. So it's 3% plus the return on the market of 12 minus 3% times the beta, and IBM has a beta of 1.21. Okay, so let's calculate this. So we have 9 times 1.21 plus 3, 13.89%. So what this is saying is that for me to be compensated for my risk, I need to be requiring a return of 13.8%. They expect the return to be 13.03%. Should I buy this stock or not? And based on this, is the stock undervalued or overvalued? Yeah, it's overvalued, because the reason it's overvalued is because this is what I have to make to be compensated for my risk, but I'm only going to be getting 13.03. Now, realistically, I would look at this and I wouldn't let this sway me if I liked IBM, because there's so much margin for error here. This is the average of what these analysts think it's going to be. So if this number is higher, it's not going to take much for that, if that number is higher, for my expected return to go up. And also, you know, you've got problems with these assumptions. These are just assumptions. There's also a problem with beta. What did I say? Remember what I said? How is beta calculated? What are they using when they calculate beta? Exactly. So that's not a predictor of the future. Historically, that's how IBM has performed against the market, but it could be lower, or it could be higher. So you know, it's all based on these assumptions. So anyway, this is a good tool, but there is, I mean, if the numbers are really far apart, it's a little more meaningful. If they're close together like this, then you could say, well, I would look at other reasons too, as far as whether I would or would not invest in IBM. And I would be kind of inclined to, well, they have it as overvalued, but I would look at other sources. I would be kind of inclined to invest in IBM on a dip because of their dividend yield. It's a steady company. I mean, it's a good company. Here's their 52-week range, $105 to $150. Okay, let's pull up another one, and I'm gonna have you guys calculate this one on your own to see how, just for practice. So here's your formula for the capital asset pricing model, and then the expected return, the capital gains is the year end, the 12-month price minus current price divided by the current price. And you're going to add the dividend yield. Okay, so let's pick another company. Anybody throw out a company there. Here, let's try Ford. Ford's an interesting company. So Ford, there's this might be this could be some of this. I don't take too much stock in what they say here, overvalued or undervalued, because I think I think that might be kind of dated. But anyway, they have Ford as undervalued. Okay, so go ahead and do the calculations for Ford. The year-end target price is $15.41, the 1-year target. It's trading at 14.16. Look at how much money you could have made in Ford. Look at this 52-week range. It's been as low as $6.50. And so here's today's price. Here's the 1-year target. Here's their beta. And they do not pay a dividend. So you just leave that off. When you're calculating expected return, you just don't add a dividend. They did pay a dividend. They have a date. Hang on a second. I'll come back to this. Yeah, they're not paying a dividend right now. So let me go back to the summary. Okay, so go ahead and calculate that. The required return and the expected return for Ford, and see if you agree that it's undervalued. Okay, did you guys get 8.8 and 13.17? Okay, so their expected return is 8.8%. That's 1541 minus 1416 divided by 1416. And then their required return is, their beta is 1.13, so 12 minus 3 times 1.13 plus 3 is 13.17. So again, maybe it may be good buy right now. It's had a pretty good run, but probably I would get for it on a dip. So the market is at record highs. Well, I mean, the market has had a little bit of a pullback, but you might find this with a lot of your stocks, that the market has gone up so much that a lot of your companies might be overvalued. Now, considering that the market's gone up so much, we could bring this down maybe to 10% or 8.5%. That would change it a little bit. But anyway, when I would suggest, go ahead and use these numbers as your assumptions when you're working on the project and calculating the required return, and just see what happens. You'll probably find that a lot of your companies are that they're fully valued or might be slightly overvalued though. Okay, are there any questions on that? Okay, let's have a review for the final, or review for exam one, I'm sorry. And then we'll come back to Yahoo and we'll talk about the assignment of the contest. All right, so let me minimize this. Okay, so here's a study guide for the exam. The exam is, you can bring in a formula sheet and a calculator. The exam is going to be a lot of mostly problems and short answer. There might be a few multiple choice. So I would basically make sure that you look at the notes, look at the PowerPoint slides, and then if I've focused on whatever I focused on in the lectures, go back in the book and read those sections in the book. And so the exam will consist of some, possibly a few multiple choice, some definitions. We have to fill in the definitions, problems, and short answers. So if you just, read the PowerPoint slides, notes, read the sections in the book that I focused on, and then use the study guide, go over the homework, you should be in good shape. So for chapter 1, the entire chapter, you're responsible for the entire chapter. For chapter 2, you don't have to look at the section on foreign securities. For chapter 3, there will be several time value of money problems. You don't have to do the uneven cash flow section. And then for chapter 4, the entire chapter. And then for chapter 5, you can skip the portfolio theory section and then go over the assigned problems. I changed the assignment on the for chapter 5 on the questions. Well, I may have gotten rid of 6, but anyway, go over the assigned questions and then problems 1 through 3 in particular, pay attention to those. So the homework is for chapter 5 is going to be due by midnight on Friday, and I'll post the solutions on Saturday. So you can you can see how you be able to work the solutions out for chapter 5. So the exam's pretty straightforward, but you should be fine as long as you put the time into study the material.
We post the study guide.
It is, yeah, it's on Google. And if you have any questions while you're studying, feel free to text me or email me, give me a call. Okay, let's take a look at the assignment. All right, so this portfolio contest slash assignment is, I hope you really like this. This has really been a popular contest. I've been doing this for years. And my former students will come up to me when I see them around campus or in town, and they'll say that they're still watching their portfolios and that it's really helped them to learn how to invest and become interested in investing and being responsible investors, not speculating. One thing that I did notice when I taught this class over the summer, it was the most speculative portfolios I've ever seen. I think it's a direct result of Robinhood. People are, you can get into Robinhood with just a little bit of money and speculate. And I think it's in all this craziness with Robinhood and GameStop and AMC has really caused your generation to really be speculative. But that's very dangerous because eventually there's going to be a correction. Eventually we'll have a correction, and all those people who are speculating in Robinhood, they're going to get washed out. We've seen really good times really for the past 12 years. The market really hasn't had much of a correction. But just to put this in perspective, from 2000 to 2010, for the first whole decade, January 1, 2000 to December 31st, 2009. If you had your money in the market, you made nothing. The market went up and down, and you made 0% if you had your money in stocks for that whole decade. So it was really a tumultuous decade. That won't repeat itself. But my point is, it's better to be a more cautious investor and diversify and just have a long run time horizon. Now, for the contest, I don't care what you do. If you want to be speculative and try to win the contest, that's fine. But when you're putting your real money in, you definitely would want to be a little more conservative. So it's up to you whether you want to just put everything in one sector and try to, you'll either, be up or down, or have more of a conservative portfolio. So over the summer, it was really interesting because normally as a group, our class usually beats the market. We've always beat the market. Last summer, we did not. We had a few people who made quite a bit of, we had pretty high returns, but the majority of people lost money last summer. And we actually didn't beat the market. Again, it goes back to being speculative. Okay, so anyway, let's talk about this contest. So what you should be doing now is just start looking at stocks, just doing some general research. What would you like? Maybe what are you interested in investing in? That Corsair company sounds really interesting. So you can invest in Bitcoin if you want to. If you want to invest $1,000 in Bitcoin, COIN is an ETF that's fairly new. That is Bitcoin. Dogecoin is another one. That's like a fake thing that Musk came up with that. And that's another one. Dogecoin. There's Bitcoin. Anyway, you can invest in whatever you want. It's got to be a buy and hold strategy though. So you can invest in mutual funds, exchange traded funds, individual stocks. So you're going to pick 10 stocks and or 10 equities, and you're going to invest $1,000 in each one. Now, I'm just going to go over this real briefly because this doesn't really pertain to the contest as much as your portfolio, and I don't have enough time, as much as your project. You're going to look at these three areas when you're analyzing your stocks. So just kind of be thinking of them a little bit as you're picking your stocks, but we haven't covered them in depth yet, so don't be worried if you're a little fuzzy on it. Okay, the macro variables. That's just kind of the big picture. What's going on in the economy? Economic policy, interest rates, what the current presidential administration, how would that affect the industry and the stock that you're picking? So, for example, what's going on with let's talk about Corsair. What's going on with the gaming industry?
There's a chip shortage right now, which I'm sure is affecting everything, gaming, all related.
Chip shortage is a buying opportunity.
But it's a weird stock. So like, I've been following it for a while. I have in my IRA. But it like had this massive pullback and it stayed down in the 20s for like the past almost 6 months now. But before that, it was like went up to 40 of the evaluation of the company, and then it dropped down back to 20 and keep doing this. And then the last pullback, it just
Never rebounded. So it sounds like people are speculating on it a little bit. So like with the automobile companies, with the gamers, there's a chip shortage. So the chip shortage means that there's a shortage of these products, and it's affecting their bottom line. It's affecting their top line and their bottom line. It's affecting their sales. But once that resolves itself, they should increase their profitability. So I would see that as more of a buying opportunity. So if you're picking one of the like all the COVID stocks, the travel stocks, like airlines, for example, they've been doing well. What do you think is going to happen with the airlines? People are going to start flying. Of course, we're going to see an increased demand for flying. However, what do you think about business class flying? In the very long run, are there going to be as many people flying as there were before COVID? Will that affect the company, the airlines? Those are just some things to think about. So, there are probably going to be fewer business people flying because companies realize now we don't have to fly people all over the country for meetings. If it's not a super important meeting, like meeting a new client or something, they can do Zoom. And so why should I pay for you to go fly to San Francisco and pay for you to go to a hotel and eat at nice restaurants and drink at night? I can just make you do Zoom, which is not fun, because that's kind of happened with these conferences that we have to go to as academics. It's not fun doing a conference presenting a paper on Zoom. Who wants to do that? You want to go to the city and attend the conference. Anyway, so just think about those kinds of things. Let's see, Starbucks. If you pick Starbucks, that's actually kind of a defensive stock in a way. They went down a bit during the last recession. I mean, some people are not going to buy a $5 cup of coffee if there's a recession, but there's enough addicts, there's enough coffee addicts out there to keep buying it. So they're a little bit recession proof. So you get my point. So just think about how are these macroeconomic variables affecting the company, affecting the industry. Okay, next you're going to look at the fundamentals. That's going into Mergent, which we'll talk about later. Mergent, you've probably seen that on Yahoo. That's a service that our library has. We can look at company information. But you can go to Yahoo and you can look at some key financial ratios and just see how is that company doing? What does their quick ratio look like? What's their ROE? What's their ROA? Return on equity, return on assets. What's their debt ratio look like? How does it compare with a couple of their competitors? So you're not going to have to calculate all these ratios, but you can just look at some of the ratios that are already done for you in Yahoo and compare those ratios with another company, a competitor, just to see how they're doing. So that's the fundamentals. How healthy, how does the company look financially? And then the last one, this is really interesting. This is the technical analysis. That we're going to have a chapter on that later. That's looking at these charts. Basically, all that is looking at the charts to see, by charts, I mean, for example, the moving averages, which is the average price of the stock is. And so, for example, here's one example of a chart. It's a moving average, and it's just, here's the, let's say this is the price of the stock, okay? And then this is the moving average, the last 200 days. And so if a stock crosses above its moving average, that's seen as a really positive sign, and the stock would be a buy. Also, but if a stock is way up here on its in the chart, maybe it's due for a downturn. So the technicals, and I'm going to show you some specific things to look at. The technicals are basically looking at these charts and trying to see if the stock is going to turn and go lower, or if it's going to go higher. Basically, that's all that is. So what these charts do is they try to look at things in they look at things at extremes and try to be contrarian. Like if the stock is way down, they try to use the charts to see if it's going to go back up. It's going to turn and go back up. If the stock is way up, they try to see if, well, is it going to turn and go back down? And so a lot of academics don't really put much credence in these charts. Because they basically, I have an old textbook that basically said our brains are hardwired to look at patterns, and that's all these charts are. It's just patterns of historical information. It's basically meaningless. But think about this: if enough people believe in the charts out there and are acting based on these charts, it kind of becomes a self-fulfilling prophecy, right? So that's the third part. So this has nothing to do with the contest. This is what you're going to be thinking about. This is what your one-page summaries are going to have. And then you'll also compare the expected return to the capital to the required return. That's going along with the fundamentals. And then just just be sure to write a concluding paragraph on each page, and just sum up, why else are you, in summary, why else are you picking this stock? You might just say, after you do all this research, you might say, well, I just have a good feeling about this company. And my friends use the product a lot, or what have And so you might just have a gut feeling. There could be any reason that you're picking the stock in addition to these. Okay, so once you've chosen those equities, you're going to write up a one-page summary for each one. Include those 3 areas that I mentioned. You're not limited to that in your rationale. Okay, this is the contest part. So 2 weeks from today, on Monday after 3 o'clock, and I'll send you guys a reminder. The market closes at 3. When the market closes at 3 o'clock, you need to get all your closing prices. And you're going to take those closing prices and you're going to enter them in Yahoo and create your portfolio. Then when you come to class at 6 o'clock, you need to either hand me a hard copy of your portfolio or you need to upload it to Moodle. It's just a screenshot. And I just need to know the screenshot should show the stocks, the price, and how many shares. Right? And so that's going to be due on the 11th of October. And then we're just going to watch it. And that's the contest part. And then you'll write your report. The report's due December 6th. We'll talk more about the report as the weeks go on. But then on Monday, December 6th, we're going to print out your portfolio again. I'd rather that, or you can, well, it'd be easier for me if you printed it out instead of turning it in on the portal, because I'm going to look at it in class and pick the winners. So print out your portfolio and turn that in on December 6th, and we'll see who the winners are. So you can see, you can watch it over the next couple months and you can see how smart / lucky you are. It's pretty much luck over 2 months. Over several years, I'd say more smart than luck, but definitely luck over the next couple months. So, okay, so that's the assignment for the contest. And some of, I talked some about what about the report. Now let's go back into Yahoo and I'll show you how to actually do your portfolio. All right, let's see here. Get out of this. Okay, so when you get into Yahoo, you're going to have to sign in, and you're going to have to set up an account. Now, I don't have my password here. I've got it in my old edition of the last book. If you really don't want to set up an account on your own, send me an email and I'll send you my login information and you can get in here and just set up your account in my account. It doesn't matter to me. But it's not a big deal to set up a Yahoo account. You just put in the email, username and password. But if you don't want to set up your own Yahoo account, let me know and I'll give you my credentials and you can use this account. Okay, so let's pick some stocks. Let's pick 10 stocks real quick and I'll show you how to set up this mock portfolio. Okay, so let's see what's Corsair.
CRSR.
Okay, so we're going to do CRSR. We're going to do IBM. I'm going to pick a couple interesting ones for you. Buzz is, so this is an ETF. So you have mutual funds, you have ETFs. This is really interesting. It's gone down a little bit. It's up about 11% over the past few months. So all this social media stuff, how they, GameStop and the story of GameStop and AMC theaters and all this. So Buzz is a fund, and they decided, let's create this fund that uses artificial intelligence to try to pick stocks based on what the buzz is out there. And so they're looking at what's going on on Reddit what's going on in all these social media things, and they're using all this, putting it all into this big system, using artificial intelligence to try to pick investments based on that. So I invested in this because I'm really interested to see if they have, if they're onto something. So anyway, that is interesting. Now, if you pick an exchange traded fund or a mutual fund, of course, you can't do the same type of analysis that you could with an individual company. So you can just, talk in general, you can just pick a few of their largest holdings or what industry they're mainly in and just talk about that. Okay, so so anyway, Buzz is one of them. Does anyone else have anything there? What are some stocks that you've been thinking about putting in your portfolio? Johnson & Johnson? Okay, J&J is good. But can't forget Apple. Disney's always a popular one. This is MO is Altria. That's my favorite defensive play in the whole world. It's a tobacco company. Pays a really good dividend. I've had it for years. It's just awesome addition to a portfolio. A new oat milk. That's a recent IPO. It hasn't been doing too well. We need two more. Any ideas? Let's do Home Depot, and let's do Walmart. Okay, so you've picked your 10 stocks. Now you're going to go in. Now this is Monday, October 11th, and you're going to pick the closing. You're going to put in the closing prices. All right, so let's look up these closing prices. So we have CRSR. They closed at $27.93. Okay. IBM. $138.56. $25.83. $163.17. So I picked my stocks and I have my closing prices. Okay, now what you're gonna do is you go into my portfolio here. Once you've signed in, and you will, so if you want to, actually next, remind me, well, I'll send you guys an email and I'll give you my password, because you can go in here. Here's some old students, past students who have had put in portfolios, and that we have, there's some sample ones, and then there's whole class portfolios in here. So if you want to get some ideas on some different stocks, you can look at some of these past portfolios. Some of the some of the returns might be a little bit off. If you see some really crazy returns out there, well, you might see some crazy returns because some of these portfolios have been around a long time. But if a stock splits, when the stock splits, the price, like it's 2-for-1 split, the price is cut in half and you have double the shares. It doesn't account, this doesn't account for any splits or anything, so that could throw the returns off. But anyway, you feel free to come in here, go in here, and as I said, I'll email you my password, and you can look at some different, get some ideas. Okay, so what we're going to do, so you get in here to my portfolio, and you're going to create a new one. Now, I don't see it up there. Oh, here it is. See right here at the right hand side here, you click on create portfolio. So I'm going to say fall 2021 sample. And I'm going to hit submit. Okay, now I'm going to add my symbols. So you just add your symbols separated by a comma. So I'm going to put in all these symbols, CR, SR, separated by a comma, IBM, Buzz, J&J, Apple, Disney, I think that's all of them. Okay, so now that so what did we do so far? We got into the website, you registered, you clicked create portfolio in the upper right hand side. Then you went to add symbol and you put in all your symbol, your ticker symbols separated by a comma. So this is our, now I have to put in the prices. So once you get here to this section, then you, let me see what you, got what you have, how you get to the, hang on a second. Oh, you go to my holdings. This is the summary page. You go over here to my holdings. And then you click on add lot. And this is where you're going to put in the transaction date. You're going to put in the cost and the shares. So this is where you have to figure out how many shares you're going to buy. All right. So for Walmart, I'm going to put in today's date. It's today, the 27th. And the shares, well, the cost is 120, it's the closing cost, so it's going to be 142.25. And then I'm going to divide that by 1,000 and see how many shares I can get. Okay, that's 7.02 shares. So what I would do, I wouldn't do all these fractional shares. I would just round up or down. It's not going to be exactly $1,000, but then when you get to your 10th stock, you can force it to equal 10,000. So I'm going to show you what I mean there. So I'm going to buy $7,000 worth of or 7 shares. I'm gonna buy 7 shares of Walmart. Okay, so 7 times 142.25 times 7, that's 995.75. Okay, so that's how much Walmart I have. Okay, then I'm going to come down here to Home Depot, and their Home Depot's 341.41. And I'm going to, let's just get 3 shares of that. That's going to be $1,024.23. Okay, and then Oatly is that was what? 1603. That's going to be 62 shares. That's 993.86. And then Altria is 48.74. That's 20 shares. That's 974.80. Okay, so you guys get the idea here? Okay, I should have just picked 5 stocks. So let's just say, let's say that you've done all this. Do you have any questions on how to get these? Okay, so you've done all this, and let's just say hypothetically, you're at 9,000 and $56. So you're going to take, you want your portfolio to equal $10,000. Okay, so I would take the 10,000, and this is my subtotal. I've got this, I have this stock left, and it's got to equal 10,000. My subtotal is $9,056. So this has to equal then what, $944. Right? So now what I'm gonna do is I'm gonna take the 944 divided by 2793, and that'll tell me how many shares. That's 33.8 shares. So you can just do round lot shares. I mean, you can do whole shares of 9 of your stocks, and then the 10th one, just force it to equal $10,000. All right. So then anyway, once you finish all this, then you just then you go back to the summary page, and it'll show you, see right here, the ones that I've done. It shows me what the shares are and the last price. And then once the market opens the next day, then it'll start to change. So the price will change, and then up here it'll show you what your gain is, your day gain, your total gain. So when you finish this should equal $10,000.